And now, Lifestyles Unlimited presents the Real Estate Investor Radio Show. Over the next hour, we unfold your map to financial freedom. You'll learn how to retire through investing in single-family and multifamily real estate. You'll learn how to create cash flow and build wealth so you can have the time and money to live the lifestyle you want.
Welcome to the Lifestyles Unlimited Real Estate Investor Radio Show. I'm Mike Harrison, and yes, we are always working on your financial freedom. That's what we do here at Lifestyles Unlimited. We are an educational and mentoring group. We've been in business over 30 years. We have members in all 50 states, and our mission, frankly, is to teach you effective means to invest in real estate so that you, too, can become financially free and retire yourself. Today's show effectively has been 12 years in the making. You see, 12 years ago, I bought my first rental property, ran that property, and essentially, I don't feel like I did a very good job. But at the end of the day, I still made a 9% return. And that's when I told myself, heck, I've got to figure this out. I've got to get better at what I'm doing. I've got to find a way to see if I'm doing this right. Am I doing it wrong? I guarantee there's people out there that can teach me, and I found Lifestyles Unlimited, joined Lifestyles Unlimited. That was 10 years ago, and everything changed after I joined Lifestyles Unlimited. I learned so much and started using the Lifestyles Unlimited model of investing. Not only did I learn, my wealth and passive income grew significantly. It was a life change. 4 years ago, I started doing the radio show, and I love the radio show. I honestly feel I get more out of it than our listeners. It's very humbling, but what it does for me personally, it keeps me focused 365 days a year, 7 days a week on real estate investing. Keeps me ingrained and focused so that I'm constantly have my eye on the ball on what I want to do, and I want to grow that passive income. I want to grow my real estate wealth. Well, in doing so, as a real estate investor, there are 7 principles that I learned as a real estate investor, and I would have not learned those any other place. My first move was not a smart one, and email me if you'd like to discuss, but my first play was to buy a very nice property inside of a self-directed IRA, and that is not very effective at all. One, if you're doing that, I like the idea that you're thinking about real estate, but the big wet blanket on top of the whole thing is, why would you put an investment that essentially can pay you tax-free inside of a tax-sheltered type investment, the IRA? So you're kind of taking away that privilege, and you're not paying yourself, you're paying your IRA. And then, oh, by the way, when you pull money out of that IRA, you're going to pay tax on it, right? It's taxed as essentially personal income when you finally do begin to pull out of it. Now, what was my trigger to leave that conventional world, right? What was it that said, you got to change? Well, the trigger was, and every financial planner will tell you this, it's called the 4% rule. In fact, online, a lot of these guys today, guys and gals, are using a 3% rule. So what is this rule? It basically says if you accumulate a certain amount in a 401k, IRA, whatever, your retirement fund, right? Let's call it your retirement fund, whatever that's made of. If you pull 4% out on an annual basis, that's what you can live on. And theoretically, right? Do you ever want the word theoretically applied to your future? Theoretically, you should be fine. This spacesuit, we're going to send you to the moon. Theoretically, you should be okay. Well, someone has to try that out, and sometimes it's not okay. But anyway, the whole idea is if you had $1 million, 4%, you can pull 40,000, and if you live off of that, you will never really dig into the quote-unquote nest egg, and it will last your lifetime, right? Keep in mind, people are having 30 and 40-year retirements. Yes, they are, right? People will retire at 60 and live to be 100. People will retire at 65 and live to be 105, right? Just sit down and do the math. Project what your savings in your 401k and IRA are going to be when you're age 65, and then hit that times 4%, and then that's what you can live on And essentially, don't forget, you got to pay taxes out of that now. That's basically, it's taxed like personal W-2 income, okay? So whatever that number is, that's what you can live on. And the reason you want to use 4% is so you don't outlive your money. Yes, people are living longer all the time. That would be a worst case scenario. If you imagine being 87 and dead broke and having to live off of whatever pittance Social Security gives you, $2,400. What's $2,400 going to be worth? My gosh, 20, 30, 40 years from now. Have you thought about that? Is anything getting cheaper? No. Are taxes going down? No. So I started investing in real estate. Just did it on my own at first, kind of winged it, made a 9% return on an annual basis. But whoa, when I joined Lifestyles Unlimited and got educated and started following the Lifestyles Unlimited model of real estate investing, 9%, no, the returns are much greater than that. But the beauty is, throughout this whole process, I've learned 7 very solid principles that have helped me and, quite frankly, thousands of other people in their real estate investing journey. The first one I learned was you cannot save your way to retirement, right? I've been talking about that at the whole intro to the show. You must invest your way to retirement. And honestly, I didn't really understand what they were talking about. Keep in mind, even as a real estate investor prior to Lifestyles Unlimited, I had that self-directed IRA. I was, quote unquote, trying to save my way differently than the 401k. I'd changed at that time. A different manner. And I'm like, whoa, no. That's what you do. That's what I've been told for decades. You save. And then at the end, you have this fat bag of cash that you can just pull out of. So let me give you 2 scenarios. Let's take the high W-2 and the low W-2, and hopefully that'll catch everybody. All right. And I've got friends that are in this area, folks that make $400,000 a year. Think about if you're making $300,000 a year, or even $200,000. You have a $200,000 a year lifestyle. If you're making $300,000, I promise you have a $300,000 a year lifestyle. Now, all these quote unquote financial planners always say, well, you'll need less in your retirement, so you won't need the $300,000. Is that the retirement you want? You're making $300,000 a year, and when your body is old and broken and you finally hang it up, you want to have some subpar retirement? No, you've already essentially built in this way of life for you and your significant other. You're not going to step down. So how much do you have to sock away into a 401k or an IRA for a $300,000 a year lifestyle, right? You want $300,000? Well, let's reverse engineer it. The 4% rule. We're going to need $7.5 million. 4 goes into 30, 7.5 times. 7.5. Can you save that? Now, is that $300,000 or is it not $300,000? Well, it's pre-tax. You're going to pay $40,000 to the government. It'll probably be higher by then. So that's really, it's not $300,000, it's $180,000. But whoa, I had this $300,000 lifestyle for 20 years. Well, how do you get that back? Well, I sure hope you save greater than $7.5 million if that's the lifestyle you want. Keep in mind, every million is $40,000. So let's say you have $2 million, you're going to go to that $80,000 a year take home. Remember, we don't want to outlive our money. That's a very solid truth right there. We don't want to outlive our money. So that is the dilemma for the high earner trying to save their way for retirement. Now let's take the dilemma for the low W-2 earner. Number one, it is very difficult as a low W-2 earner in society today, in the capitalistic market called the United States of America, to even save right now if you're a low W-2 earner, right? You don't have necessarily a bill problem. You've got an earnings problem. So if you're making a low amount or even, middle amount, it's hard to save. I'll tell you, someone who brings home $100,000 a year and is married and has 3 kids doesn't have a lot of money at the end of the day. I mean, the government comes in, they take theirs. Then if you've got mortgage or rent payments and then food and then taking care of the kids and all their needs, and then you probably got some car notes, you've got everything. And then just life in general, right? Little things, bam, there you go. Cell phones aren't cheap, but it's pretty much a need today. So the dilemma for the lower earner is just putting enough money to save. Keep in mind this 4% rule that's in the background. And like I said, there are some financial, quote, analysts, and I use that term loosely, that are saying, no, it needs to be 3%. So every million really is only $30,000. Think about saving just $1 million, right? That is daunting. That's not going to happen for, I promise you, 70, 80% of people out there listening to me today are not going to be able to amass $1 million, at least unless they start when they're really young. And how many 20-year-olds do you know that are going to set aside 20% of their take-home and put it in? That's what they tell you. That's what the standard is. So you can't save your way to retirement. You must invest your way to retirement. There is an exercise that we do here at Lifestyles Unlimited, and it's called Calculate Your Return on Net Worth. And we do that calculation, and essentially it says, if you're worth $1 million, how much are you getting paid, right? Different, monthly, quarterly, annually on that. I'll talk about return on net worth on the other side.
Got questions? Call Lifestyles Unlimited at 855-497-4335. The Real Estate Investor Radio Show continues next.
So when I say be ready, number one, to get ready, you better join up Lifestyles Unlimited and learn all these things we're talking about. You're out there piddling and, internet information and your buddy's information or your dad's information. It's not going to get you the results that we're talking about. You're going to have to be educated in what we're doing.
Learn from the people that are already where you want to be. Join us for the free online workshop at lifestylesunlimitedworkshop.com.
Creating the lifestyle you've always wanted. You're hearing Lifestyles Unlimited's Real Estate Investor Radio Show.
Welcome back to the show. Talking about 7 very important principles that I learned as a real estate investor, that I learned as a member of Lifestyles Unlimited. And these are 7 principles that I apply to my daily investment decisions that I make daily, annually, going forward. And they're nothing you would ever learn. You can go get a doctorate in finance. You won't learn these concepts there. In corporate America, at one time, I managed a portfolio business well over $100 million in sales. I didn't learn these concepts there. You won't learn them in high school. You won't learn them from your parents. My parents weren't aware of this. They just taught me what they thought was the best for them. And that doesn't always work out, right? My dad was a big bond investor. God, thank the Lord I'm not a bond investor today. My gosh. But that first concept was you cannot save your way to retirement. You must invest your way to retirement. 401k, IRA, that's nothing more than a savings account, putting money in your house. That's not doing you any good, having all that debt equity. You got to free those dollars and go put them to work. If you can put them into a real estate, cash flowing real estate investment that's now paying you 15, 20, 25% annualized return, often much greater. I've seen many that are 100% annual returns. I've seen many that give you your money back with a refinance, and now you're earning an infinite return, right? Because you got your original investment back, and now we can go plug that into another one. That's called compounding your wealth, right? That's really the another leg of the stool, right? It's not even my money anymore. It's house money. The original investment's still in there. So you got to invest your way to retirement, invest your way to wealth. Second thing I want to say along these lines, you can't time the market, all right? Don't time the market. Timing the market that's a stock market thought, right? Buy low, sell high, okay? And again, as I'm sitting, the first time I took the Financial Freedom Seminar, we talked about that. That's a concept that's applied to stocks and bonds, right? The only way to make money in stocks and bonds is essentially appreciation. And even when you try to time the market, what happens, right? You may even be looking at a stock that has a cycle that historically it trades around 50. and it'll go down to 40, and then a few months later, it'll be back up at 50, and then back down to 40 for what have you. You can find those stocks that have those patterns, and you can always buy at 40, and you can always sell at 50. But there's the invisible hand will always get in your way in stock market investing. That invisible hand is world events. It's Wall Street. It's Washington, D.C. politics. That invisible hand, some decision is made, and bam, you're down 30%. So the stock market's a dangerous place to play. It is essentially gambling. Now, let's look at real estate. When I say there's no timing in the market, many of you are like, well, Mike, houses are so expensive right now and interest rates are off the hook. We're still pertaining to our internal, one of our 3 rules is must cash flow. So even if I buy a house today, when I'm doing my analysis on that house, I'm plugging in a 6.5% mortgage rate. If I've still got cash flow at the end of the day and I've got an equity capture, we're buying today. And if you can make money at a 6.5% or a 7% interest rate, when or if interest rates ever come down to 3 or 4, and I'm not saying they will, I think we're going to be stuck in this cycle for a long period. I think we got a couple years of this stuff, but that's just crystal ball stuff, and I'm no economist. But if you're cash flowing at those numbers, then that is a cash flowing investment. So you don't time it. When I was buying houses from 2013 to 2016, after the crash, every year the realtors were telling me houses are just getting so expensive right now. And you'd buy a bunch in 2014, 2015, 2016. And yeah, the prices were coming up a little bit. It was still cash flowing. They were still fantastic investments, but people at the ground level that weren't necessarily real estate investors just couldn't believe how expensive houses were. Well, maybe it's expensive, maybe it's not, but do your analysis. And if it cash flows, then you've got something to continue on to the next side. So we don't time the market as real estate investors at all. If you time the market, you sure be waiting a long time, because houses did nothing but go up after 2013 all the way to about, a few months into 2022. So up, 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 up. And for all those timers that were emailing us or talking about this in 2018, 2019, 2020, well, they missed out, okay? Next principle. Act now and stay active, okay? This is an ongoing process. You need to turn your assets at a time when they make sense. So I'll tell you this, the first year of owning a rental property, often your returns are 100+% in that first year. You've got an equity capture that you plug in. You've got your cash flow that's based on that. But then year 2, if you're doing it smart and you have, let's say you were out of pocket $40,000 and there was a $40,000 equity capture. So essentially you made 100% return in year 1. In year 2, I am now considering an entire $80,000 worth of equity, and I am going to mathematically challenge that return based on what I have in that property. I physically only had $40,000, but I have an additional 40 in brick, sheetrock, shingles, flooring, countertops, appliances. So I have $80,000 in this property. So suddenly I'm going from 100% return to something much lower than that. I still may have cash flow that's 10, 15%, but that's going to go down, okay? Your return goes down, your equity goes up. And there's another thing that's kind of quietly happening every month. The resident pays the rent, right? And then you pay the principal, okay? You're paying the principal, the interest, the taxes, and the insurance. But back to that principal part, it might only be $100, $200, $300 a month. But again, that's now knocking down. Your principal is coming down. You have more money in the deal. And when that deal gets to low returns, and it doesn't take very long, you'll be at sub 9%. Remember, I told you I didn't know what I was doing. I made 9%. So personally, for me, if I'm making less than 9% in a property, it's time to evaluate that property, stay active. I may want to do a refinance and pull some money out, tax-free, by the way, and go charge that down the road on another property. I may want to sell that property, but you got to keep turning it so you can keep your returns high, okay? You got to keep your returns high. So that's that stay active part. I know a lot of people that they'll buy 8 rent houses, right? And then they'll tell me, Mike, I've owned these 8 rent houses for 10 years, kind of out of sight, out of mind. We've got a management company, and I now have $1 million in equity. And I'm like, whoa, what are we doing? Let's go free that mill and let's go put it to work. And so people get comfortable, right? People get comfortable. They get complacent. They don't want to get out of their comfort zone. That's a human nature thing, okay? That's not unique to any one person. It's unique to all of us. Now, the fourth principle, wealthy people buy streams of income. Think about that. It's from a gentleman by the name of J.D. Durham. And J.D. Durham is a real estate savant. He's one of our mentors here. He's a teacher. He is a great, great guy. J.D.'s forgotten more about real estate than I'll probably know in a decades of doing this over my lifetime, but just a wealth of knowledge. But when you start looking at this at a 40,000 foot level, what are we doing? Okay. Are we buying a rental property? Are we investing in an apartment community? No, we're buying a business. We are buying a stream of income. This is how millionaires look at things. Okay. They're buying streams of income. You want to buy a new truck and it's got a $700 a month payment. Well, do you buy that new truck? Or do you go buy 2 or 3 or 4 rental properties and then buy the truck? I know what I would do. If I was in that situation, I would allow the rental properties to pay for my new truck. What that's called is called chunking. So the principle here is you don't go out and buy a new car. You buy 1 or 2 or 3 rent homes and you let the return of the rent homes pay for the car, the cash flow, right? $50,000 on a car, or would you rather have 2 cash flowing rental properties? I know what I would have. The car is going to die in a few years, okay? The car is going to go away. It's not going to be worth anything. But the rent houses, they're always going to be there. But then again, back to what I spoke about earlier, you got to watch those rent houses. You may sell those rent houses after 3 years and reinvest in some more properties, all right? Keep churning it, keep it going. So number 5, principle number 5, an effective education is priceless. Like I said, you don't get this stuff out there, okay? You don't get it. We teach it here at Lifestyles Unlimited. There's a lot of other real estate investors that understand these principles, but this is not common every day. Like, you can't go pick up a book and find, here's the 7 core principles of real estate investing. Chapter 5, an effective education's priceless. Okay. There's a lot of education out there, but you got to find the one that's going to essentially do what you need it to do. Okay. If you're going to college and I'm going to throw some rocks at college. Okay. I'm not saying college is always bad. The right degree for the right individual is just fine. Don't borrow to get it. That's the real epidemic in society. But I will tell you that the majority of what is taught in our higher level institutions aren't really preparing those folks for the true reality. They're not preparing them for the cold, cruel world that's getting out there. People are getting out of school and they're disenfranchised, right? Even the ones that don't have $50,000, $100,000, $80,000, what have you, in debt, they're disenfranchised. Now, a lot of the STEM folks should be just fine, right? That's effective. You've got your science, your technology, engineering. We need more engineering. That's all out there. But I'll tell you, there's it's like a societal, just a wave saying, to be successful, you must go to school. No, to be successful, you just got to track down that effective education, right? That effective education, something like a roadmap to financial freedom. Even when I started real estate investing, I bought that first property in a self-directed IRA. I didn't have a book telling me how to do it. I just figured out that that's where my bundle of money was, and I need to buy a property within that self-directed IRA. And I was so proud when I went to the 2-day financial freedom seminar, and Dale Walmsley's up there teaching the class. And then he said, if you want to ride with me for lunch, I got room for 3. Man, I shot my hand up and stood up. Yeah, I'll ride with you, because I wanted to ride. He's the man, right? He's teaching the class. There's probably 60 of us in this class. And he kind of goes through, tell me about yourself, and the guy that's sitting in the front seat, he talks, and then I'm in the back seat, and then someone else talks, and then I'm like, my name's Mike Harrison. I've got a house in a self-directed IRA, and I'm looking at the rearview mirror, and he kind of glances back to me, and he's like, yeah, if you want to be effective, you'll sell that house and you'll get out of that self-directed IRA. You pull your money out and you'll put it to work buying real estate that works for you. I mean, it was a slap in the face, but it was an effective lesson. And that's exactly what I did. And things change. They will never be the same after that. Principle number 6, you get rich by borrowing. Leverage, leverage, leverage. I'm not talking about consumer debt. I'm talking about institutional financial debt that you are applying to a cash flowing real estate asset. The bank is your friend. It makes the returns so much greater. I just talked maybe 2 shows back. You can find it. A member of Lifestyles Unlimited, but prior to Lifestyles Unlimited, he bought a very nice property. It was several $100,000, and they sold the property for I believe it was about $160,000 gain. But when you start doing the math, well, on one hand, there's a lot of people out there that'll go, you made $160,000. That's huge. You did great. No, his return was 31%. I think it was a 6 or 7% annualized return. Okay. What if he had bought a bunch of, instead of paying cash, you utilize that leverage and you get a ton of homes that are paying you money. For instance, I had a home 6 years ago. I purchased it for, about $140,000, but I was out of pocket $35,000. My cash flow was in the 500, so it was in the, let's call it an 18% return. But if I'd paid cash, I would have been out about $170,000. Okay, so you got rehab costs in that original purchase. My monthly cash flow would have been higher, but my returns wouldn't have been at the 18 to 20% range. They would have been more like the 7.7% range. Leverage maximizes your return. And I know it's a very short snippet on that. And if you'd like to explore it further, send me an email, askmike@luinc.com. But I can give you example after example after example why you want as much not as much. I like to keep 25, 30% equity in the property. A lot of that I get when I buy it on the equity capture. But you want a sensible amount leveraged to the bank, okay? You want to keep that equity piece so that you can adjust and adapt if need be. That's kind of your safety measure there. Okay, the last principle. This one's very important. Wealth is created, okay? You need to believe in the abundance mentality. You go out and create wealth. When I make $1, I'm not taking that dollar from somebody else. I am creating it. I'm taking this old, rundown jalopy rent property. I'm putting money, and we do this with multifamily properties all the time. We put rehab dollars into it. We make it nice. We make it clean. We make it functional. We fix everything, and suddenly that house is worth much more than what we paid for it. It's worth much more than the rehab that we utilize. And often the bank is our friend, is paying for the rehab side of the business. You created all that wealth. It wasn't there, but you also paid GCs along the way. You paid flooring people along the way. You bought product to put into the house and redo it. So you paid all these different people to help you make that house much better, much nicer. Boom, here's your check, here's your check, here's your check. But at the end of the day, I now have this asset that's worth thousands more. Wealth is created. I want you to always remember also, very important, it's not the money. It's the lifestyle. Make it a great day. We'll see you next week.
The information and opinions you hear on the Lifestyles Unlimited Real Estate Investor Radio Show are those of the host, guests, and callers. The Lifestyles Unlimited Real Estate Investor Radio Show is for entertainment purposes only. Please consult a professional regarding your personal investment needs. Nothing presented constitutes an endorsement, recommendation, offer, or solicitation to buy or sell any product or security.